context, with global markets as the benchmark. We facilitate research by IMA faculty and doctoral students working in finance, economics, business strategy, and related areas. The center organizes seminars, workshops, and conferences. We also engage with relevant regulatory authorities who influence policies, as well as industry bodies and other stakeholders who are significantly affected by policies. I'm also excited to announce that we'll be having a conference on Fintech in March 2023. The conference is organized together with CAFRAL, which is a research institute promoted by the Reserve Bank of India. I would encourage those of you who are working on Fintech to submit your papers for the conference. So with this brief introduction to the center, I hand it over to Professor Gopalakrishnan to take it over for the webinar today. Over to you, Bala.
Yeah, thank you, Sanket. Good evening, everyone. At the outset, let me welcome you all to the webinar organized by the Mishra Center for Financial Markets and Economy. I'm very happy and honored to welcome our distinguished speaker. So today we have with us Professor Ashok Banerjee. Professor Ashok Banerjee is the director of IIM Udaipur. Professor Banerjee is a chartered accountant and holds an MCom degree from Calcutta University and a PhD from Rajasthan University. Professor Banerjee is a seasoned academician with vast experience as a senior professor in the finance and control area. His research interests are in the area of high-frequency finance, fintech, and sentiment analysis. He was the Dean of New Initiatives and External Relations at IIM Calcutta from 2012 to 2015. Prior to joining IIM Calcutta, he was a professor at IIM Lucknow. Professor, again, a very warm welcome to Mishra Center at IIM Ahmedabad. The webinar has very good attendance, and we all look forward to the presentation. Professor Banerjee will be presenting on Fintech Lenders, a threat to shadow banks. Participants may post their questions through the chat window, the Q&A window. Professor, during the presentation, please allow us to interject for questions. Over to you. Thank you.
Sure. Thank you, Professor Sanket and Professor Bala. And welcome all the attendees today. It's my privilege to be here and present our work, the recent work on this platform. As Bala was saying that prior to joining IIM Udaipur, I was with IIM Calcutta. In fact, I was with IIM Calcutta for almost 2 decades. And I have joined Udaipur just 2 months. So still, I cannot just forget my days in Calcutta. That's why you can see, even in my name, IMC is mentioned, not IMU. So it shows that 18 years versus 2 months. But this is a joint work with 2 of my students, former students. Anirban is currently a faculty at IIM Ahmedabad, and Deep Narayan Mukherjee, he is with PCG, heading their data analytics division, and also visiting faculty at IIM Calcutta. Now, when we were debating what should be the title of the paper, and I put this title, that is Fintech Lending or Fintech Lenders, a threat to shadow banks. Deep had a different take. He said that, shadow bank, the way we understand it in the US, doesn't apply to NBFCs in India, because shadow banks are mostly less regulated entities. But in India, RBI regulates NBFCs almost at par with banks. So he was not happy with this title. But I say, let us stay with this title and then see, we might change it later. So with this, I would like to start my presentation. I tell the participant, as Bala mentioned, that if you have queries as we go with the presentations, please put it up on the chat, and I'll stop for Bala to summarize these queries, and I'll try to answer. This is the first draft of the paper, and we are seriously and sincerely looking forward to your feedback. That will only help us improve the paper further. We all know the role the traditional lenders have played over, decades and even centuries. With the help of regulators across geographies, they were able to increase their size. And with that came economies of scale. And the traditional lenders claim that their competence and expertise in screening of application is unparalleled. And that's what they bring on the table. And their due diligence is fantastic. However, the papers in the last 4 or 5 decades have shown that these traditional lenders are not always doing the great job, particularly when there are situations of credit rationing or pulling of borrowers, different types of borrowers. For example, even today, the traditional lenders are reluctant to lend to new to credit customers. Despite fraud by RBI, despite reports by credit bureaus that these new to credit customers are not bad customers, only thing they have not availed credit in the past, but still, if you see the data, the traditional lenders are not willing to come forward and lend. That's one problem. The second is the ultra short-term interest rates. So the interest rate that these traditional lenders were charging on the credit cards and also personal loans were prohibitively high, even for applicants with a higher credit quality. So they claim that they have better due diligence and screening of applications, and they have economies of scale in terms of deposit mobilizations. But in some loan product, it was found that they are charging rates as high as 20% to 30%. Now, as a result of this imperfection, that means screening applicants, not giving credit to everybody, despite having better quality, and charging higher interest rate, those imperfections led to the emergence of these fintech innovators and the platforms. So given this background, what we find in the literature that the fintech companies gained momentum after the global financial crisis because people lost faith on the traditional banks. So they started booming. But in India, they are there for maybe 5-7 years, not for last 15 or 16 years. Now, when these fintech lenders came with technology, they disrupted the BFSI. And therefore, even the big daddies and the incumbents, they started adopting technology, particularly on onboarding of applications and loan processing. But still, we find in the study, we'll see in the data that fintech lenders who use technology, they perhaps use it much more smartly than what they use. We found that although onboarding of applicants is now at par, what the fintech guys do versus NBFCs and banks, but in terms of alternative data that the fintech lenders use, the other lenders have a lot to learn from. So therefore, in this paper, we ask the following questions. First is, first of all, this question is not listed here. Who are the fintech lenders? We use an operating definition. That how do we define who is a fintech lender? And then we look at these 5 questions in this paper. That means who borrows from fintech lenders? If we find that guys who go to fintech lenders for borrowing are completely different from those who go to other lenders, then there is nothing to study because there is a different cohort they are serving, and those who go to banks and NBFCs are completely different lot. So therefore, there would be differences. So we see first who borrows from fintech lenders. Second, we see that the claims. There are already papers to show that fintech lenders are better underwriters. So are they really better underwriters? Third, we see that whether early tech adopters, like in metro cities, for example, in Bangalore, in Hyderabad, whether the cities which are early tech adopters, we see more concentration of fintech loans there. So are fintech lenders more concentrated in top 30 cities in the country? That's the third question you see. Fourth, the point I just mentioned, that the new to credit customers, that's a segment that traditional lenders are still hesitating to lend. Do fintech lenders provide them credit, which otherwise they don't get it? And final question you look at is during the pandemic. So we use this major natural shock and see that moving away from loan performance, we ask a fundamental question that do fintech lenders provide the much needed liquidity? Because studies have shown that during 2020, 2021, 40% of working population have lost their job. 19% of the population, those who have lost their job, had to resort to short-term borrowing. So there, the question was survival rather than repaying loan. So therefore, we look at this question that whether during this crisis, Fintech lenders were providing the liquidity, where the liquidity suppliers. So there are the 5 questions we look in this paper. Bala, anything? I see some hands raised, so, or I continue?
I guess you should continue with this. Some specific questions, but these are examples. So I think please continue. Professor Banerjee, just for the sake of understanding, so these fintech lenders are regulated fintechs, right? Not the ones that are private.
I'm coming. That's my next slide.
Sure.
So just responding to Bala, so who is a fintech lender? We use a working definition. So our definition is fintech lender is one who offers application and onboarding process completely online. Number one, no brick and mortar model. And number two, they must be registered with RBI as an NBFC. So unregistered lenders are not in our data set. So whatever we read in the newspaper about the wrong practices are mostly to do with these unregistered ones. We don't look at them. Reserve Bank of India in a report in 2020 says that there are 2 types of NBFCs registered with them. One are digital only and one have both digital plus brick and mortar. We identify digital only NBFCs as fintech. In fact, the credit bureau from which we got the data, they also classify NBFCs into 2. One they call only NBFC, and for this kind of entity, they call it NBFC/fintech. That's what we use. Now coming to the data, to answer those questions, we need data. And we must thank the CIBIL, TransUnion CIBIL, to provide us this data. Of course, it was hard work. We have to really pursue for more than 1.5 years to finally get the data. But we got a gold mine of close to 900 million individual loan data, various products and across lender types. In most of the papers that are there in the market, published papers on fintech lending, they look at 2 buckets, fintech lender and others. They don't look at division within the others. But the richness of this data is that we know the lender type. So we can actually find out, are the other lenders are banks? And if it is bank, is it PSU, private? If it is not bank, then is it NBFC? So we have much granular data. Secondly, because we have loan level data, the customer level data, which is matched with the lender, we can look at this pair and to see the stickiness, the lender versus the borrower stickiness. But then there are some, noise in the data. So there are some joint accounts and they came as separate lines as if there are 2 loans. So to avoid confusion, we dropped the joint borrower loans. There was some customer ID missing, so we could not track the trail. We dropped them. And we dropped loans before 2015 because there was hardly any fintech at that time. If we filter out those data, we lose about 250 million type of data point, but still we have 600 plus million data. Now, out of this, our attention on this paper is on personal loan. And that too, mostly for 2019 and 20, the COVID year and the year before. So out of this 636 million, personal loan, that in 2019 and 2020 were close to 54 million. So bulk of our work is on this 54 million data points. Now, how this data point looks like. So if you look at retail loan market in India, this is number of loans, okay? This is not the value, number of loans. What you find is that top 4 products pretty much constitute more than 80% of the total number of retail loan products and retail loan accounts in India across years. Out of this top 4, if we remove or leave out agricultural loan and gold loan, because agricultural loan, a priority sector, gold loan doesn't have a default probability problem because you have gold against the loan. So their essential problem is the loss given default rather than the probability of default. So if we take these 2 out, then we have consumer loan and personal loan. Consumer loan we use as a counterfactual, but our main concentration is on personal loan because if you look at the growth in the personal loan, it was higher than the consumer loan over this period of time. So therefore, we concentrate on personal loan. So if we zero in on personal loan, these are aggregate numbers and see who are the lenders who are providing personal loan, then the picture appears much more interesting. So if you look at personal loan and zoom in on this, we see the emergence of this fintech as a lender. You can see here that in 2015, they were nowhere there, hardly any loan given by the fintech guys. So fintech story is essentially a 5-year story in India, given our sample period. And NBFCs were also not dominant. So if you look at 2015, out of 3.4 million loans given under the personal loan category, they were dominated by banks. But the scenario completely changes 5 years down the line, and you see suddenly the banks have hardly grown, whereas NBFC and fintech have grown. NBFC grew by maybe 10x, but fintech by many folds. So therefore, fintech actually dominates the entire personal loan market in the recent times. So for example, in 2019, which is the pre-COVID year, out of 30 million, 40% is fintech. And next is NBFC. So the entire battle, that's why we say it's a battle between fintech and the shadow, which is NBFCs. The private sector and the PSUs don't really operate. Now, these are again overall personal loan. The picture gets clearer if we divide personal loan into ticket size. So if you look at personal loan for 2019 and 2020 divided into ticket size, starting from 20,000 and then going all the way up to 100,000 plus, picture changes. Meaning whatever little PSU bank and private bank, the traditional bankers presence we saw, it is mostly in above 100,000 size. At 20,000 and 20 to 50,000 dominated by fintech and NBFC, which clearly shows that the size or the segment of borrower where fintech operates, the traditional banks don't operate. So they have no threat. They may not like to operate because we were talking to some bankers. They said that our transaction cost is high because the diligence time almost is saying if I process a 100,000 rupees loan versus a 20,000 rupees loan, so we don't want to be there. So therefore, the real fight is between fintech and NBFC, and we therefore look closely into these two categories. So given this background of the market, the personal loan and the retail loan market, let us look at the profile of a borrower. So we looked at the lender and the market. Now let's look at the profile of a borrower. An average fintech borrower. Who borrows from fintech? There are studies already in the market. So what others have found that fintech borrowers are mostly male, married, educated, from higher income bracket and young. So that's the kind of demographic profile of a fintech borrower that others have found. And they found that these fintech lenders don't chase low quality borrowers. By the way, to pursue their high growth targets, they're not chasing the bottom of the bureau scores. They are also neither at the top. The tops PSU banks can take them. So they're slightly in the middle. And this study also found that if the history of the borrower is not good, fintech lenders don't normally lend. So this is what they found. Now, we don't use this kind of demographic characteristics in our study for two reasons. One, we don't have this. Even if we had it, we would not have used it. Why? Because in India, we talk to the bureau and we say that, do you have this data of, say, education qualification, the profession, their income, etc. They say, see, in KYC, the lender takes the Aadhaar card, and then lender has a form where the borrowers voluntarily give this information about their education, their income, and so on. Those are not verifiable. These are self-declared. So therefore, we don't want to classify a borrower based on something which is not verifiable. So therefore, we did not ask for those demographic data. We rather try to create a profile of borrower which are based on verifiable data. So we say, okay, let us have a model where we will try to find out who has a higher probability of borrowing money from a fintech lender. And as an explanatory, we're using the credit size because you just saw if the size is small, they go to fintech. We look at the credit score because credit score matters. Other papers show that they're in the mid tier. We look at the credit count. That means the urgency. How many times are they repeat borrowers? Then the credit history, delinquency, and in the past, have they taken education loan or any secured loan, etc. So we look at these variables which you can defend with data and not something which is not defensible. And what we find is a very interesting, profile emerges. So here our dependent variable is, 0, 1 kind of variable. If you take money from fintech, then it's 1, otherwise 0. And first we run it on individual variables, explanatory, and then main attention is on the last column, which is our equation number 9. And what you find here is that the credit size is small. You can see a negative coefficient. So the borrowers who look for a smaller size that we already saw in the descriptive stats, they go to fintech. Secondly, their CIBIL score is lower, but that's not hugely lower. We have done a economic significance. We found it is about 0.2% difference. So 0.2% lesser. So not much of difference between borrowing from a bank versus borrowing from fintech. So they are not aggressive and reckless. However, the credit count is high. Credit count high means they are taking repeat loans. Now one can argue that these fintech loans, because the ticket size is small, it is natural that the credit count will be high because these loans are like 6 months. So after 6 months, I can take another loan. So therefore, in a year, I can actually take 2 loans because I repay and then take a fresh loan. But yet, it kind of shows the credit appetite. It might encourage, credit habit of a borrower. So that's what we find. The credit count increases, but they have a smaller credit history. Those who are borrowing for fintech, they are not historically borrowing for the last 5 years. So that's why the credit history is negative coefficients. Their historical delinquency is also lower because we saw in earlier papers that if in the past they had a delinquency, the probability of getting loan from fintech is lesser, but they have taken education loan. Now we don't know whether this loan is for their own study or from family, but at least some money they have taken for education loan and so on. So that's the profile. So borrowers, we don't know.
It's a proxy for young cohort, perhaps, education.
Perhaps, but we don't know whether his or her own education or somebody else's. We don't know that, so we can't claim.
Speculative.
Speculative. But what emerges is small ticket loan, urgency. They have a better, relatively good credit quality and no credit history or low credit history. That's where fintech comes to them and says, "Hey, we are here to give you loan." Now,
also, there is one question from the participant. So,
sure.
Can you give an example of this fintech NBFC to take a name, perhaps?
Lending card, for example, big.
Yeah.
Okay. And if you say simple NBFC in our data set, Bajaj Finance. So just 2 examples. Yeah. Okay. So now question is that if the fintech lenders are lending to people with a lower credit score, less history of the trail, meaning they're called thin files. They don't have a thick history, recent borrowers, and they have an urgency to borrow. What is the performance? Because fintech lenders claim that they not only onboard the borrowers better at the time of loan origination, they track them also. They recover the money faster. So what about the loan performance? Now,
so Banerjee, can I ask one question here? Going by the profile, although you have not explored it, but it seems that people have shown that fintech lenders are primarily young and affluent.
Borrowers.
Borrowers. Sorry, borrowers are young and affluent. So, and what we generally see is the range primarily is less than 1 lakh, or is that so? Are they replacing what they could basically? Is this a replacement of some sort of a credit card to long-term loan? Because are they? The profile tends to match somewhat. So I was wondering whether you have any information on their either they have credit cards or they're using it less, or the poaching essentially is not traditional banks or NBFCs, but essentially their day-to-day purchases, which they are, instead of going for a short-term loan, which they get from credit card, they go for a long-term, which fintechs are willing to take over.
Good question, Vasu. So let me tell you two things. One is the literature shows that they asked a question whether fintech lending leads to debt consolidation in the hands of the borrower. So I had 5 loans. I take fintech loan and repay say credit card, so I consolidate my loan. Those papers show that that's not true. So essentially what they do is they take fintech loan, prepay or repay the credit card so that they have a better score. Next time they improve the credit limit and again go for higher credit card usage. What we found is these small ticket borrowers did not have credit card, very small percentage had credit card earlier. So it is not that they're taking loan to repay. However, after taking loan, they have got credit cards. So they were not in the market. They are new to the credit market. But then when they got the credit and they repaid on time, other products, other lenders, because during our period of studies, even NBFCs were not allowed to issue credit cards. Forget about fintech. So only the PSU and the private banks were allowed. So therefore, because PSUs and private banks were not operating in this space, they wanted a certification. Now, because fintech had given them money, 20,000, 50,000, and they repaid on time, the PSU banks have approached them. So we found these borrowers are getting credit card later. So it is not consolidation of credit, it's rather expansion. That's what we found.
Thank you.
Okay. Now, this result that we saw, somebody might argue that this is for the overall total personal loan portfolio. What about 20,000? Because fintech lenders don't operate in entire personal loan segment. We find that our results hold even when you slice the personal loan into buckets. So what we saw at the aggregate level also holds when you just look at under 20,000 bucket. The first column is under 20,000, same story. Second is 20 to 50, same story. So if you see that trade count is positive, so whether they are borrowing 20,000 or 50,000, if they come to fintech, they have a habit of borrowing, repeat borrowing. Remains same. So given this,
just one more, one thing. I suppose the results are not clustered at any level. The standard errors are not clustered in this regression.
Yeah.
So that is why the numbers are very high, which typically tends to happen with like 27 million data points. Like the T-stacks are very high. So you might probably want to consider clustering at the same levels as fixed effects, which is suggested in literature.
Okay.
So that actually brings down because essentially the actual number of observation which might be important probably comes down with clustered standard errors.
Good.
That's
Yeah. Sure. Thanks. So now we look at loan performance. Now we have a reference paper, 2020 RFS, very well cited paper by Barg, Manju Puri et al. And they use default event as one where they claim they have used the Germany data and they classify default as one, where the claim has been transferred to a recovery agency. But in our paper, we use the RBI guidelines. We define a default event as one where the repayment is 90 days past, not 30, 60, 90 days past. Now, this matrix will spend maybe 1 or 2 minutes. Very interesting matrix. It shows transition. So let me explain. If you look at the first panel and look at the last row, overall row, and go to the last column, you see the total number is 54 million. So this is the total number of personal loans that were disbursed during 2019 and 20. Okay, now look at the transition. So what you find is out of 23 million, 23.8 million of, if you look at this row, fintech row, the first row, 15.5 million, they remain with fintech. That means if they have borrowed in 2019 from a fintech borrower, they remain also with the fintech for subsequent loan. That's the loyalty. If you look at NBFC, out of the total 8 million remained with NBFC. However, 4.7 has gone to Fintech. That means if in 2019, suppose, they borrowed from NBFC, in 2020, 4.7 has gone to Fintech. So there has been transition from NBFC to Fintech, similarly Fintech to NBFC, Fintech to banks and so on.
Just a clarification. So this doesn't, these are only repeat loans or only all the loans? So including repeat loans, top-ups as well as new to
All the loans.
So when you say
54 million
fintech,
into all the
fintech,
loans.
so when you say fintech, it's not only loans that has been repeated by the fintech, but also new loans issued by the fintech.
Yeah. Now, what is interesting is how did the transition affect their performance? So look at panel B, and the story is like this. A borrower who borrowed from an NBFC in the last year, suppose, and continued to borrow from NBFC this year, their delinquency was 10.26%. Whereas the borrower who borrowed from NBFC last year, but have transited to Fintech this year, delinquency has gone down to 6.51%. On the other hand, a borrower who borrowed from Fintech and stayed with Fintech, 4.5% delinquency in 2020. Whereas those who have left Fintech and went to NBFC, their delinquency dropped to 11.6%. It seems that NBFCs are facing some adverse selection problem. Those who are doing good in NBFC, because these numbers are average, Fintech were able to attract them through the ease of use and promotion or whatever. And those who are not doing good at Fintech, because Fintech, they track the loan performance, they let them go. And NBFC, because you saw Fintech in 2019 flipped, the number of accounts flipped from NBFC to the Fintech. So earlier Fintech was having more number of loans than the Fintech, NBFCs. It flipped in 2019. So NBFCs did not want to leave that, lose that space.
May I interject you there? Because NBFC was growing in 2019 as well. Only in 2020 we see a degrowth.
Yeah.
So is it really a switch out?
You see the rate of growth, Fintech was growing at a faster pace.
Agree, totally.
And that happened mostly in 18-19. 20 will come later. 20 is an abnormal year because of COVID. We have a separate story for 20. What I'm trying to say is, NBFC, which was the leader, banks were never a leader. They saw fast erosion of their market share. So rather than Fintech, what you found, NBFCs, which are non-Fintech NBFC, became more aggressive in onboarding. So maybe Fintech have let those accounts go to them, which were not good. And that's why to see
do we know when these loans were originated? Because you could have a vintage effect, that there is a legacy issue for NBFCs. The Fintechs were having very low base to start with. So is that showing up in the delinquency?
No, so we did not use up to 18. These are all 19-20 loans.
So originated in 19. Yes, sir.
Right.
Yeah, and if I may add, the ticket, the maturity profile of the loan are all more often than not sub 1 year. So the vintage effect is likely to not be significant.
You're right. All I'm saying is, if Fintechs are actually tapping new to credit customers, then they don't have a legacy issue, unlike the NBFCs and the banks, is my point.
So they are not all new to credit. They had trade in the past, but not a long history. They had a thin file. So last 4 years, maybe one loan kind of thing. Not a thick history. Hello, Rivi. So what we are trying to say is that perhaps, and then my next slide shows a more robust test, but perhaps, NBFC is losing for maintaining the market share and the loan accounts. They are reckless or not taking care of the recovery, maybe. So therefore, let us do a proper, analysis of this and exploration. So we did a simple regression where we use, loan performance dummy. As we say, 90-day past is bad loan, so dummy of 1, otherwise 0, less than 90 days. And what we find clearly is that the beta 1 coefficient, if they had taken loan from Fintech, the probability of default is lesser. So you can see, and we found that is 0.05 because this is 10 on the other side, so 5% lesser chance of default. And CIBIL score is as usual. So CIBIL score is very much there, which means if a borrower has a high CIBIL score, definitely their performance will be better. So the negative coefficient CIBIL score is expected, but even after CIBIL score, if the borrower has gone to fintech, you can see a delta. So CIBIL score coefficient is not going down, but still we have a significant negative coefficient for the beta 1, which means that given the same CIBIL score, if the lender is a fintech lender, the performance improves. So that's what he found. But one might say, this is a result which is influenced by all types of lenders. So it has all ticket size. It is not 20,000. So then what we did was we looked at two things. One is remove PSU banks and private sector banks. Just look at NBFC and the fintech, meaning between two NBFCs, and look at the ticket size also. Now, as I mentioned earlier, that we have used personal loan category, and we found that
Professor, there were a couple of questions which I missed. So can I go on to ask that? So
Sure.
this is from the earlier slides. Is there any possibility that these fintech borrowers were earlier borrowers from MFI? So again, the question on legacy, the microfinance institutions, are they actually tapping those funds?
Yeah, so I take that question. So MFI reporting also happens in the bureau. So someone whose NTC basically have not taken any money from any of the RBI registered things. So it will not likely to have taken from MFI who are NTC.
Okay. The next question is from Abhijit. So he asks, why not only also have a specification with city time, interacted with month. So now you have city fixed effects and month separately. You can interact and perhaps capture any time variant effects as well at the city level, because especially you have the COVID year. So if there is any hotspots or say containment that is happening only in one city, a city interacted with month would actually capture those omitted time variant effects.
We'll try to do that, but look at the data size. So we have that effects. We'll see how it was in SAS. But yeah, noted down the point.
Fair enough. And one more question from Jadinder. Are all these loans dispersed through digital channel only? So for the fintech players?
Yeah, because we define fintech player as those which are only using digital channel. There's no other channels.
Yeah, so there is another question which we'll take towards the end. That's more of a generic question. Yeah.
Okay. Next. So therefore, this result, somebody can say that, this is all inclusive, but you show that only fintech and NBFC are the real players. So why not look at only that cohort to compare, apple with apple, like to like. So because it's personal loan and we saw only the two are the dominant players, it is better that we compare between fintech NBFC and the non-fintech NBFC. There is another reason why we should compare them, because their balance sheet structures are similar. They have fewer products to offer, unlike banks. Banks can offer any kind of products. So therefore, we zero in into kind of mass sampling sort of thing. So first column is the column you saw here. So first column here, the first more results are like the last column, the column number 6, same results. And then we sort the data. So the model 2 represents the entire subsample, and model 3, which are issued either by fintech. So model 2 is loans which are within one standard deviation of fintech loans. So size wise, this is one standard deviation plus minus for the fintech size. Model 3 is, but that is even by private sector banks and public sector banks. Our main attention is 3 and 5. In 3, we look at only those loans of similar ticket size given either by NBFCs or by fintech. And in model 5, same as 3, but only for T30 cities, top 30 cities. Is there any city kind of difference? And what we find is that our results hold. So that means if we remove public sector banks, we remove large size loan, we concentrate on 20,000 around buckets and just look at two players, NBFC, non-fintech, and the fintech, we find that our results hold. If this is fintech lender, fintech borrowers, they repay, their performance is better than the non-fintech NBFCs. So our results, what you saw at the aggregate level holds even at the subsample level, where you look at smaller ticket size, similar trade profile. So you can see our features that you have used to sort them is loan size, CIBIL score, and the credit count the last 4 years, and last credit difference, which means last loan taken and the next loan taken, how many months of gap. So to show the urgency of both. So given all this within one standard deviation, we still find that fintech dummy results hold. Therefore, it has nothing to do with the overall size or with, it's not disturbed by, abused by the presence of banks and larger size.
Professor Banerjee, if I may interject. So there's a question from Professor Nirav. So his question is, why do more borrowers prefer fintech firms? Is it technology-driven ease of borrowing, the adoption, less documentation, lower cost of debt, or multiple factors? So he's conjecturing if the primary reason is technology, given 30 to 45 age group, I think that's what he's hinting. They're more proficient in handling technology. What do you find is likely to be simply general borrowing behavior or characteristics of a new generation?
What we found, and we mentioned in the paper rather, is that, see, in terms of onboarding, today even traditional NBFCs are also using technology. But the traditional NBFCs, what they do is, they collect information from the borrower, whatever information, ABCD, through that platform and app, and then they use the credit bureau score. That's it. What the fintech guys do is, they willy-nilly, unknowingly take consent of a borrower to access their mobile app, and they see what other apps they're using. So they use a lot of other alternative data point to do a better assessment of credit. So if you ask me onboarding experience, whether a traditional NBFC today is using an app to onboard, yes, they're using. But in terms of due diligence, the number of data point that an NBFC uses, traditional one, is a fraction of the data point that others use. For example, lending card claim, they use thousands of data points, social media data, the bank data. So they take your consent. So borrower finds it easier because they ask only 3 information from the borrower directly, and others they take consent. I agree with this condition, and through that they actually pull data from other sources. That's what we have seen, but we have not got all those detailed data. But that's the reason why perhaps this is the performance. Now, question is, in this table you saw that yes, if I just look at NBFC and fintech is doing better. So naturally, somebody might say, is NBFC always a bad underwrite? No, forget about fintech. In earlier also, but they're bad. So there are 2 interpretations possible. One is, if if the NBFCs are historically greedy, aggressive, and are bad underwriter, then if fintech does better, you can't say they are actually using some artificial intelligence. On the other hand, if you find that no, fintechs traditionally, NBFCs are not bad, they have a good underwriting practice, but where a fintech comes, they bring something more, then you have to give credit to the fintech. So there are 2 possibilities. Fintechs are no better in terms of underwriting, or they are better. Now, how to test it? We have to test it using some counterfactuals. That means look at a product where NBFCs dominate and fintech is not even the second player. They're a minority player. So somebody else is the competitor of NBFCs, and that product or loan segment is consumer finance. So earlier we said that we'll bring consumer finance here, which you saw, they also have a large accounts. If we see consumer finance data from our data set, you see a clear dominance of NBFCs here. These are non-fintech NBFCs. And the second is private sector banks, not the fintech. This is a market where fintechs don't really dictate or dominate. NBFCs dominate. So let us see whether NBFCs do a bad job here in terms of loan underwriting and performance, because here fintechs don't operate. And what we find is that no, NBFCs do a good job, because here we looked at performance, again, same definition, 90-day plus is bad loan. And we're using private sector bank dummy as the dummy. And we find, you see, positive coefficient, which means if the borrower, if the lender is a private sector bank, they do relatively poorer to the NBFC. Because here, fintechs are very small. So therefore, it cannot be said that NBFCs are generally bad loan underwriters. It is where the fintech dominates, they bring something additional. So to answer therefore Nidav's question, that it is not only ease of onboarding, they use something extra. And we have already support in the RFS 2020 paper, which shows that what all alternative data they use. We don't need to prove that. That's already established in the literature. And these results show that private banks are also, traditional. So private banks are not using technology more than NBFCs. But when fintech comes, they bring something extra, and that's where they are called a better underwriter. It is not luck. It is actually because of some AI and some intelligence that goes on. So that's the major segment of our paper. Then we show the other questions, which are kind of a little minor question. One was
if I may interject, so is it that, so are you kind of hinting that they are doing well in the consumer loan segment, NBFCs? So we can't really conclude that fintechs are dominating the underwriting vis-a-vis the NBFCs, right? They're a small player.
Yeah.
So NBFCs are doing fine in the consumer loan segment, where it is mostly sales finance or the durables that they finance. And is it a choice issue here that NBFCs don't want to go for personal loan segment as it is?
No. Maybe I'll take that. See, I think consumer durable lending in India in terms of NBFC, there are actually an over dominance of one or two players. In terms of
Bajaj Finance 75% market share. Yes.
Yeah.
So it's mostly one player who's overwhelmingly dominant.
So can you conclude that it is poor underwriting that is perhaps, or rather the superiority of fintech in the personal loan space that is leading them to pick up a lot of customers? Can we conclude that? Because
we can't. Maybe it is better recovery. They chase. So see, loan performance is not only underwriting at the time of origination of loan.
Yeah.
What they do, they claim again. It is in the website that they monitor, they use intelligence for early warning signals. So they look at credit card utilization, restaurant consumption, and other data to see the likelihood of customer going to default. So they take proactive steps. Now, we cannot verify them, but these are anecdotal evidence in newspapers.
Correct. Even the paper that you have mentioned that, but isn't it a bit problematic? Because say Natch debit, etc. is where you can stop in terms of collections, trying to recover the money. Typically, collections involve foot on the ground. So that probably the brick and mortar NBFCs are more superior in terms of handling it. So fintechs might be, you are right in terms of preempting, delinquencies or, having auto dialers, etc. They will be good. But wouldn't that be a, kind of a stretch in terms of claiming they're superior in terms of recovery? And especially personal loans, which is unsecured. Is it NBFCs are not going there?
No, NBFCs are very much there. You saw in the personal loan, in terms of number of loan accounts, they are very close to the fintech. Fintech has grown in the last 3 years. So
Okay.
what we are finding is, and you saw the transition metrics, that the transition is that the borrowers who did not repay on time, fintech did not give them second loan.
Okay.
But NBFC perhaps have given them second loan. And that's why the delinquency went up.
That's an interesting result, to be frank. And that's very, the performance of NBFC being poor. I think it's a strong result.
Strong, and that's
Professor Gopalkrishnan, I think one conjecture is, it is possibly, we do not have a view on the recovery, we don't have the data, but potentially, or as far as conjecture goes, it looks like whatever is the underwriting setup NBFCs have on an average, the fintechs may have a better underwriting setup. Obviously there's an element of conjecture because as Professor Banerjee said, it's the whole thing from underwriting to collection. But yeah, we have subsequently controlled it for CIBIL score profile, and we are seeing that thing borne out everywhere.
Thank you.
Yeah. Can I ask one question? Like you had shown one regression where there was an educational loan domain. So there is some idea of what kind of borrowers they are. Of course, you're trying not to include it in the whole analysis. But the profile of the borrower itself, I'm sure that the fintechs are using more of information. But is that information probably related to simple demographic factors that might be influencing? For example, if somebody takes an educational loan for a purpose of education loan, the likelihood of them paying it back through their own means or through their parental means seems to be reasonable, because and the fact that these are not small, they are small ticket loans. So I was wondering whether that is whether the profile of the borrower itself matters to some extent.
Two things I can say, Vasu, is number one, as I mentioned also earlier, we do not know whether the education loan was taken for the borrower or any family member. Maybe his or her son, daughter, we don't know. So therefore, age profile we can't say.
Okay.
Secondly, education loan delinquency is high in India. It's not that education loan delinquency is low. Only thing we are saying is, in the history, you saw the regression, secured loan coefficient was negative, which means these borrowers did not have collaterals. Because had they had collaterals, they would have gone to a private sector bank or a public sector bank to take loan. They don't have collaterals. So naturally, the first question they ask. And that's why they're coming to fintech. Just to have the data very clean, we don't know. That's why you use personal loan, because the only advantage in personal loan is there's no filtering based on whether I have security to pledge. Because personal loan is definition unsecured. So therefore, for a borrower, they could have gone to anybody else. So I'm not filtering them based on whether I have asset in place. That's not required. Even for consumer loan, Deep would say, consumer loan also, although we say the borrower will have to have an asset to buy to get the consumer finance, but from the lender side, it is like unsecured loan. Because very difficult to, so the LGD is almost 100%. What do you recover? You take a fridge out, you can take a TV out of the house. So therefore, for the lender, consumer finance loan is almost like a personal loan. But for the borrower, yes, there's a difference.
No, what I meant to primarily was mention, like if somebody wants to unsecured, let's say even give a reason that education loan, even though they might not be using it for that, they are more likely to go for fintech, right? So that profiling might help you think about from the borrower side. I'm just hinting, of course. I know it better.
I know, but we tried. Unfortunately, the bureau is not sharing with us any data on borrowers' demography, like age, etc. We have, only thing we have for every borrower is, other than the loan information, is their zip code, the PIN code. And that we use for doing the city effect and the city.
But in general, if you find in various other reports or industry anecdotes, most of the loan, any loan, is actually in the consumer's space, is broadly taken between people between 25 to 45 years. I mean, that's the largest age category. Lower age or higher age, it flattens, it trickles down to a lesser thing. So agnostic of the loan type, 25 to 45 is the largest set of borrowers.
Yeah, but we can't claim that, but that's, we have referred in the paper also. But the results we can't show because we don't have the data. But I think, Vasu, we will get some reference to this in this next segment, where we look at the city effects, that whether because fintech use tech, so cities which have adopted technology earlier, like say Bangalore, Pune, Hyderabad, whether the fintech lenders are there mostly and not in the tier 2, tier 3, tier 4 cities and so on. That's what this segment looks at. And first, the overall observations, then we'll see the data. What do you find is there's a lot of similarities between the profile of borrowers in the T30 and the beyond T30, which we call B30. 70% small ticket loans. So in both this category of cities, roughly 70% of the loans are given by fintech, small ticket, the 20,000. The average loan size, outstanding balance, comparable, T30 and beyond T30. So fintech has gone deep. It is not that they are only into T30. CIBIL score, NTC score suggests that the average quality of borrower similar in these two buckets, and the time elapsed between the last credit, that means the months between two credit, is also similar. Loan performance exhibits similar default, about 7% probability in these two city groups. Of course, number of cities are different. What we find different in these two buckets is that borrowers from T30 cities have more credit history, greater number of times they have taken, frequency, and they are more prone to default. So it is actually T30 cities borrowers, they have defaulted more in the past 4 years than in the B30 cities. So they have taken loan more and also defaulted. But that is overall T30. But we know that if we just look at fintech versus non-fintech, we find that there's a sharp difference between fintech and non-fintech category. Non-fintech meaning here everything, banks, NBFC all put together. What we find that only 5% of borrowers of fintech, they defaulted, and for non-fintech in the T30 and B30, the number is twice that of fintech borrowers. And this is even true after controlling for CIBIL scores. And then if you look at the cities which have early adopters of IT versus fintech adoption, we find this, there is some semblance. We find that there's a wide variety in the fintech adoption. For example, 60% of the personal loan borrowers went for fintech adoption is 60% for Kolkata. Even in metro, there is a divergence, whereas it's 77% in Bangalore. So given this divergence in terms of fintech adoption, if you look at loan performance in these cities, and here what we have done is, this is just 5 cities, not 5, I think 6 cities, but comparison is Bangalore versus others. So there are 5, which have, IT adoptions, excepting Kolkata, others have huge IT adoption. And I'll highlight Bangalore versus others and take you through, maybe I'll take 1 minute. So how to read this table is row minus column. So look at the first panel A, it shows that fintech lending or the loan proportion of fintech is higher in Bangalore as compared to Hyderabad, Mumbai, Pune, Chennai, Kolkata. So among these 6 cities, fintech proportion is high, loan proportion from the fintech lenders higher in Bangalore. However, it is not that they're all good quality customers. If you look at the CIBIL score, Bangalore minus others, in most of the time it's negative. So it is not that Bangalore city where people are going to fintech lender, they have a higher credit score. Credit count, yes. So not only there's an higher adoption, but they are taking more number of loans. If you see the credit count in the last 4 years, people in Bangalore, they have a tendency to borrow more number of times than in other cities. However, if you look at, so what is the profile we are seeing in Bangalore? They go more to the fintech lenders. CIBIL score is not great, so fintech lenders, they are giving loans with even poorer CIBIL score. And these guys are going to fintech for more number of times in the last 4 years. However, how they are doing after taking loan from fintech, look at panel E. If you look at past delinquency, last 4 years, coefficients are mostly in the first 3 cities negative, which means the delinquency here is lesser than other cities, but this is the past. But if you look at delinquency after taking loan from fintech, you find that Bangalore has done better than other cities, excepting I think Chennai. So
it's countering the CIBIL score, right? Isn't it? The CIBIL score is actually poor for Bangalore, but the performance is better. So is it because they're new to credit customer? So their CIBIL score by nature is pretty poor. They're all new to credit. In Bangalore, you expect young cohort IT folks to come and borrow. They have a very poor credit score to begin with, but they actually have better capacity and intent to repay. So delinquency is higher. So if you show the new to credit proportion, that might answer this distortion.
Yeah, new to credit coming later. But just to respond to your query, if you remember one of our regression tables where we showed that even after factoring for CIBIL score, if it is a fintech lender, then the performance improves. You saw the negative coefficient of the fintech. So here, because 70% is fintech proportion in Bangalore, I mean, we are seeing these results.
Yeah, I'm not disputing the earlier one. That is correct. I'm just saying that this might answer the question. There's a distortion that Bangalore has poor score, but good performance. That is,
sure. And that brings to your, what you alluded to is, let's look at the NTC. It's not small number. Our data set shows that the share of NTC in the loan origination volume was close to 17% before 2020, before the onset of pandemic. So it's not small. So we have a 54 million loan account. So NTC is not small. And what we find is that fintech lenders are more aggressive in attracting these new to credit customers. And for example, 62% of them were served by fintech lenders. And remaining 38 is not served by banks, mostly by NBFCs. They don't have a great credit score. So, NTC, they get a NTC score, which is from 100 to 200. So 140 is not a great, it's a poor score, not even in the middle. So it's below average, 140, but still they get the loan. And banks have avoided lending. I said in the initial remarks that only 19% of NTC customers get money from banks, even after CIBIL is saying please lend, RBI is saying lend. These NTC customers are not in Bangalore and other cities. Rural and semi-urban population constitute most of these NTC customers, which is obvious, because roughly 6% of such borrowers defaulted at least one time in this period, 6%. And what do you find that if so it is overall, 6% is overall, but if a fintech lender extends credit to the borrower, then it goes down a little bit by 2.33%. So overall is 6, it is high, but if it is from fintech, it is relatively lesser. But what is interesting in this NTC, there is a phenomena called volatility in NTC score. As you know, if a borrower first time takes money, there is no history, the borrower gets an NTC score. And then the CIBIL, the bureau, looks at the borrower's performance in 6 months, 3 to 6 months, and then they get a full score, meaning CIBIL score. So NTC score is a temporary score. They ultimately get a CIBIL score. But what we found is that in a short span of 60 days, 30 days, less than this time, there is a change in the NTC score. So it's not that they're getting CIBIL score, because CIBIL score takes at least 6 months time. Even within 60 days of loan origination, sometimes even before the loan is given, the inquiry is made, even before disbursal of loan, there is a change in the NTC score. And that the bureau called the volatility in NTC score. That might happen because some of the information may change. Maybe the phone number has changed, address has changed. If they change, then there is a change in the score. And what you find is, and I show the table first, is we have divided the NTC score into 3 categories. One is no change in score. So whatever was the score there before loan origination remains till they get the full CIBIL score. The second is before disbursal of loan, the NTC score falls. So there's a decrease in NTC score. And third is increase in NTC score. And what naturally you find is that cases where NTC score has gone up from inquiry till disbursal, the delinquency for fintech loan was 3.7%. But if it has deteriorated, it has increased from 3% to 5%. And this increase has been there across the lender types, so whether it's NBFC lender, fintech or non-fintech, it has gone. But what we found is even there, the difference between the delinquency levels of fintech lender and non-fintech is significant. You can see 7 versus 5 or 8, and statistically is already tested. So this volatility again is perhaps it is our another unique contribution, because nobody has looked at volatility in the NTC score and its implications therefore. So we find that if it is decreasing, people should actually avoid lending them, even if it is NTC. And finally, our last segment, that are these fintech lenders do some social good or not? Or are they only just market share and loan profitability and so on? And we find that during 2020, they do a great job in terms of providing liquidity. So if you recall our initial table where the personal loan we divided into who is lending this, we find that during 2020, the total number of, the fresh personal loans given in 2020 was not hugely different from 2019, total number of loans. It was about 24 million. So not hugely less. But out of that 24 million, Fintech contributed 53% of the new loans, not loans carried forward from 19 to 20. The fresh loans given in 2020, 53% were from Fintech. Whereas what happened with the NBFC? There was a huge fall. So NBFC's total number of loans almost halved during 2020. They are number 2, but halved. So if you look at the liquidity supply, Fintech did not reduce it. Just to give an example, the total loan book for less than 20,000 size was 63 billion in 2019, and it was 59 billion in 2020 in the Fintech. But had the lender been NBFC, it fell from 36 billion to 15. So it is not only just it is not only the number of loan accounts, it is also the value. So total put together, there is more than 50% fall of credit supply by the NBFCs. Whereas for Fintech, it is a few billion, maybe from 63 to 59, 4 billion, which shows that they have maintained the trade flow almost at the level of 2019. Yeah, Nabala, your question.
Yeah, so the example that you gave of Fintech NBFC was a P2P lender. So for a P2P lender, the loans are not in their books. So NBFCs, traditional NBFCs do have capital adequacy and other regulations which they have to comply. So of course, during COVID, do you see that as one of the reasons why Fintech NBFCs could have actually lent? Because they don't have these compliance or regulatory compliance costs which the other NBFCs are bearing, because these are not on their books if it is P2P lenders.
No. So, Bala, first table, if you recall, very first table, P2P lending is not part of our analysis. P2P lending is very, very small. These are on the books, co-lending.
Okay.
So therefore, what we find is that Fintech were providing liquidity. Now, whatever in terms of performance. So if you look at performance is 2020. So what we see is loan originated in 2019 when there was no COVID till June 2020, where we have just June 2020 full lockdown period, and then you see how they perform, because then you have run time for their loan repayment. And what you find is that, generally speaking, if the Fintech is the lender, the Fintech dummy is still negative. But if you look at Fintech times time dummy, that means if the loan is given in 2020, we are using, that means during this period of COVID, when everything is locked down, then you have a positive coefficient. See, the beta coefficient of the interaction variable is 0.02, the last table. However, the way we have to read it is that if I sum the Fintech dummy coefficient, which is negative 0.08, with this positive dummy of 0.02, it's still negative and significant. Which means that yes, during 2020, performance has gone down for everybody, but if it is a Fintech, relatively, it is still negative, meaning relatively they have done better. Somebody might say, why you're looking at performance in 2020, it is not that important because there was loan moratorium that lasted till September 2020 almost, and we have data till December. So therefore, measuring delinquency in 2020 is problematic and the results are problematic. But RBI shows that only there are 40% of these personal loan borrowers who availed moratorium, even if it was offered to 100%. 60% of the borrower did not avail moratorium. So this loan delinquency is actually testing a kind of a control sample that had there been no moratorium, what would have been the performance? So therefore, this still holds. So this is all we talked about. Now, one may argue that Fintech lenders have provided liquidity because they are forced to continue their lending book, because the lending book is only 6 months. So if they stop liquidity and that's the only product they have, they'll have nothing to show to their investors. So they have to keep lending. So the liquidity provision is not for doing a social good, but to satisfy their stakeholders, meaning the investors. Now, our answer is whether it is willingly done or unwillingly, which means they're doing some social service or because of the pressure, the end result is money is on the table. So whether it is done willingly or unwillingly, they are providing liquidity during the COVID period. So that's the answer to all 5 questions, and that brings to the concluding session remarks. It's a force to reckon with, but public sector banks not to worry. They are not in this segment. NBFCs are to worry. Just having an app to onboard customer is not the answer to play with or to fight with fintech lenders. They have to go much beyond just onboarding through an app. They have to use machine learning and all this AI techs and be more, in touch with the customer. Third, we found that fintech lenders are still not looking at 100,000 plus size. They're looking at small ticket loans, and they're operating at that level and developing competencies of better underwriting capabilities. And lastly, we found that this migration, those who migrate from fintech to NBFC are the bad accounts, and those who go to NBFCs to fintech, they're the good account they pull. So the adverse selection is hugely with the NBFCs. So therefore, the threat is for the NBFCs and not for the banks. Thank you.
Thank you, Professor. So we have some outstanding questions. Can I please?
Please.
So, one question is from an attendee. What is the data collection methodology? Is the question.
Data collection methodology is that the Trade Bureau, Civil, they gave us this data not like a data in a hard disk. So they have a data room. We are allowed to see that, write a code, and get the output. We could not download the data in our machines. In fact, they had given us a machine. So each 3 of us got a laptop delivered by Civil. Highly protected. I can't do anything else there. And we had to return it back. So once the project was over, they said, please return, we'll return it back.
Yeah, I guess, that answers it. And the next question is, why is the government and RBI not controlling fintech? I think probably topical question, but I think
not controlling any fintech is doing. Those who are registered fintech, please remember.
yes.
That's why RBI has come up with a position paper and a guideline forcing fintechs to register. Unregistered fintechs are like illegal entities, and we are not looking at them. And the registered fintechs have done a good job, as at least our data shows this.
Yeah, the last question is about the US fintech industry. They've drawn some parallels. They're saying that they have reportedly leveraged AI to enhance the credit to gig workers. So given that India expects a rapid rise in the size of the gig workers, do you see this sort of possibility in India as well? What is your guesstimate? Is a question by Anonymous.
No, see, we have shown you the gig work in the sense that those cities, Bangalore, Hyderabad, you saw what is happening there. And we have assumed that gig workers are mostly working from there. But remember one thing, it's an anecdote in my another study. During COVID and till now, the number of demat accounts, I took this paper, just to give a reference, number of demat accounts opened by retail investor in tier 3, 4, 5 cities, mind-boggling. I have seen the trading of a guy X in a city like Udupi, mind-boggling in 2020. And then after a probe, we found that guy was working in an IT company in Hyderabad. During COVID, he went home, but he was trading in Hyderabad. He went home, and now internet connection is decent in those cities, smaller cities. And he was trading. So I can't say, oh, tier 3 cities have started and they're financially literate. It's the migration that works. So therefore, you need data to answer this question. We didn't want to get there.
Sure. Next question is, sorry, Vasu, you want to take it?
Yeah, I just wanted to have your idea on this. So is there, I think from overall point of view, someone looked at delinquencies, but are there differences in terms of loan between the NBFCs and these fintechs? Because fintechs seem to be funded differently compared to NBFCs. In terms of loan, maybe the loan terms in terms of like repayments, interest rates itself, are they different significantly? Because that can also affect the delinquencies, right? So I didn't see, but maybe I think it's not the data that you have, but definitely some anecdotal evidence of difference not being different should be there. Yeah.
We don't have the price data, unfortunately. Meaning interest rate, we don't have. And for other terms, that's the reason we have used only personal loan for our study. Because in personal loan is unsecured, so terms are other terms, not pricing, are more or less similar. But pricing data we don't have.
But even a general anecdotal evidence that they are not.
So in general, I'll step in here. In general, you'd see that the cheapest PL loans happen from PSU banks and private sector banks, which would typically be, sub 10 or 11%. Whereas as you go to NBFCs and fintech, it is upwards of 14-15%.
Yeah, 16-17%.
Yes. So NBFCs and fintech, that way the interest rates are comparable. We'll not say it's exactly same. And as the product is chosen in such a way that the features are quite standardized, other than interest rate, of course.
It would have been good also to get the interest rate data, but unfortunately we inquired, but the data was not available.
Sure.
So the last question, what will be the impact of the digital lending guidelines to fintech players? Typically, many of these are just platforms and doing tie-ups with lending companies. I think they're referring to the co-lending and the prepaid instruments. Will they be able to serve customers in the long run? It's a question.
Yeah. So many fly-by-night operators are having a big trouble. Not only this prepaid postpaid thing, but also putting up on the website the bank on the behind. Because right now what is happening is those fintech companies which are onboarding customers, they don't know with which bank this fintech has a tie-up. So therefore the bank becomes a captive to the fintech front end. The fintech goes, they don't know where from the customer will come. But now RBI is saying you have to put the name of the bank up front so that the borrower knows ultimately which is the bank.
Perhaps one reason why NBFC performance is poor, they're actually keeping it in their books, the bad ones.
Right.
So anyways, I think with that, we will conclude the session. Thank you, Professor Banerjee, for taking time out to present this paper. It was a very insightful webinar from your end. I hope our comments would help in improving your paper.
Yeah, sure.
All
comments are really good. We have noted down.
Thank you. I'm sure that most of the participants have taken away a lot on the fintech landscape from your presentation. Let me also thank all the attendees for keeping the webinar engaging and interactive. We look forward to your participation during the upcoming webinars as well. Thank you and have a good evening.
Thank you. Bye. Good night.
Thank you very much. Thank you.
Thank you.
Thank you.